The same trends of the last few weeks are still dominant this week in the housing market. Mortgage rates continue to climb. It's not uncommon to hear rates quoted at over 8% for a 30-year fixed mortgage now. Conventional home buyers, those that stretch to make a down payment and maximize their home for their payment, are an increasingly tight bind. And it's not a surprise that they are sitting on the sidelines. As the existing homes sit on the market longer, inventory builds late in the year, and some price discounts are starting to creep into view. Unfortunately for buyers, none of these trends are moving very significantly. Sellers are sitting on the sidelines too. So even though inventory is climbing, in most places in the country, selection for buyers remains incredibly tight. Inventory is climbing, but unless you're in like Austin, there's just not a lot of homes on the market. Austin is maybe the one big market in the country that has more available inventory now of unsold homes on the market than any time in the last decade. A lot of what we're seeing now mirrors the fourth quarter of last year and is not surprising. We've been talking about how the impact of potentially 8% mortgage rates for several months now. Last year, though, the market changed to the positive in the first half of 2023, and that change took us by surprise. And that's why at Altos Research, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, and all the changes in that data so that you can understand it immediately as it happens. We make that real estate data available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at the signals for the week of October 9th, 2023. There are now 537,000 single-family homes on the market across the U.S. That's up a fraction from last week. Inventory continues to grow faster than last year at this time, and it hasn't yet peaked for the year. Mortgage rates are also still climbing with 8% common now. So buyers are kind of priced out and homes are sitting longer. Remember that higher rates equals more inventory. Lower rates equals less inventory. The path to finally having more selection for home buyers is through higher mortgage rates, higher for longer. If mortgage rates were to fall between now and January, expect to see inventory falling again next year, like it did for most of this year. If rates stay at 8% or higher, expect inventory to rise in 2024. Inventory is climbing faster now than last year at this time. And I've used the long time series chart here for a slightly different view of the inventory trends today. You can see that not long ago, there'd be over 1 million single-family homes on the market in October. Last year, inventory spiked when mortgage rates spiked so quickly. Then a second rate shock hit in September and bumped inventory up again last year. This year, inventory gained much more slowly for most of the year, but now unsold inventory is piling up each week, and it's late in the year for that. There are probably a few more weeks until inventory hits its peak for the year. The end of October is where last year's inventory peaked. Two things happened at that point last year. First, once you get to November, the fewer people are interested in selling before the holidays or trying to sell. They wait to list or they withdraw their listing if there are no offers. So inventory falls even with weak demand in November. But also last year, the first week of November is when the mortgage rates peaked. So for 2022. So once rates started falling again, inventory started falling. That set us up for that surprisingly strong first half of 2023. This year, if mortgage rates don't peak and they keep climbing into November or through the holidays, we could see inventory keep climbing too. The new listings volume each week remains very low, though, and there are very few sellers who want or need to sell into this market. There's certainly no flood of sellers. 58,000 new single-family home listings hit the market this week, and that's roughly the same pace as the last few weeks and the same pace as last year at this time. The inventory build is from a dearth of buyers, not from a surge of sellers. Both home buyers and home sellers really are waiting on the sidelines right now. There were actually more sales contracts started this week than a year ago, the same week a year ago. Sales have been consistently fewer all year long, but last October is when the brakes really slammed on. 58,000 new contracts for single-family homes this week. That's 8% more than the same week last year. There are only 327,000 single-family homes in contract right now. That's shockingly few. So while the comparison to last year gets easier now, there are still no signs of the sales rate improving yet. And of course, why would there be? It sounds like the most expensive time to buy a house in decades. And even if you're a cash-heavy buyer, your selection is still not great yet. In this chart, each bar is the total number of homes in contract, that contract pending stage at any given moment. The light portion of the bar are the new pendings each week. Last year, the light portion of the bar was shrinking dramatically each week with fewer and fewer sales. This year, the sales rate has been lower than last year. It's late in the season, so there are always fewer sales in October than in the early summer, but this year's October decline is less abrupt than last year. It's just another sign that inventory is increasing because buyers are holding back and homes are just sitting on the market a little longer. One number that's fascinating to watch is the proportion of listings withdrawn from the market versus those going into contract each week. Withdrawals every year climb in the fourth quarter as we approach the holidays. Many of these homes will get relisted next year. But what's notable is that last October, the withdrawals were happening at a much higher rate, much greater pace than they are now. Last year, home sellers were still surprised. Many of them were still surprised at how quickly the market had changed. And at that time, this time last year, we only saw only 52,000 new contracts with another 40,000 that had been withdrawn. This year, we have slightly more sales and this week, and about 25% fewer withdrawals. So the sellers this year are much more prepared emotionally for what the market's actually doing. Here's a different view of price reductions than I've recently shared. So there are 37.5% of the homes on the market that have taken a price cut recently from the original list price. There are more price cuts now than any recent year except last year. The chart illustrates really that tight band for normal markets, how normally about a third of homes take a price cut before they sell. When more than that need to cut their price, it's because demand is weak, and that bodes bearish for future sales prices. That's sort of where we are now. At the far right end of the chart, a third of home sellers expect to cut their price, but 37.5% have had to do so. 37.5% have had to do so. So last year, that number was over 40% in October. So this illustrates how the downward pressure on prices now are less than they were in the fourth quarter of last year. Though remember that because inventory isn't done climbing yet for the year, we can expect that price cuts are not done climbing either. So especially if rates keep climbing, the market could grow as weak as last year, but it's not there yet. Another thing that this illustrates for us is the last time mortgage rates rose back in 2018, we can see that price reductions climbed at that time as well. That was just a 4% to 5% move, 100 basis points. Last year, rates spiked 450 basis points and price reductions skyrocketed. This year's another pretty big move in rates. So as home buyers hold back, sellers don't get their offers, so they start cutting prices. So you can really measure the relative levels of home buyer demand by the change in price reductions. And right now, it shows demand is lighter than any recent year, though not as cold yet as last year. The median price of single-family homes across the country now is just under $440,000, though that's basically unchanged for several weeks. we can see that the active market is starting to feel price reductions with weaker demand. And we can see that dark red line here, the overall pressures on home prices is, again, lighter than last year at this time. And I think that's because the home sellers are much more prepared than they were last fall. Home prices are 1% to 2% higher than last year at this time. And given how quickly home prices felt the pressure last year, it seems likely that even while demand is weakening now, home prices will end the year with these same slight gains over 2022. Last year, home prices were falling pretty quickly each week. The market changed from that hot to cold. This year, the slowdown is much less dramatic. Price declines are part of the season, of course, and the best properties get listed with the best premiums in the second quarter each year. And so prices always decline in the fall and winter, but last year's change was stronger than seasonal. The median price of the new listings is $395,000. That's also unchanged from last week, and a couple percent higher than last October. Last year, the light red line here was falling by 1% per week, and that hasn't happened as quickly this year yet, though it could. There is no sign of bullishness in the data here. It's just easier comparisons with last year. There's also no sign of the bottom dropping out, but as always, we remain vigilant to see if or when home prices might have bigger moves lower. The data where the comparison with last year is most stark is when we look at the price of the home sales with contracts pending, the homes with contracts pending. So these are not yet sold, but they're no longer active on the market because they have offers. The dark red line here is the price of the newly pendings each week. Last year, that price was dropping precipitously. You can see that in the middle of the chart there. As rates jumped, buyers downshift their price point and the discounts kick in aggressively. So last year, that September surge in rates hit home prices very abruptly. This year, that impact is much less abrupt. The pending home sales will fall again over the holidays, of course. This is the earliest proxy for sales months before the sales are closed. So this is why we can see that the headlines for the next several months will report year-over-year home price gains. Those, even though we're in this weaker market. Those sales are already in contract, and those contracts are a couple percent more expensive than last year. At the far right end of the chart, the pending prices have not yet dropped substantially with the latest decline in buyer demand. And next, though, we really start shifting our focus to January when the new season starts fresh with the latest inventory and potentially new economic direction, new mortgage rate direction for the year. There is so much signal in the active market, and these market conditions change so quickly now post-pandemic that if you need to help buyers and sellers understand the housing market, help them make decisions, go to altosresearch.com and book a free consult with our team. We will help you know how to talk about this market with your clients and prospects today. There's a link in the description below to join us. More next week.